Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges, taking a look at all we are saying is give puts a chance, to quote the Beatles' famous song, John Lennon. And is it finally time to look at shorting the Q by buying some very cheap puts on an overvalued and overbought triple Q, as we always like to do? We like to use a fusion approach to combining fundamental, technical, and probably most importantly, IV analysis to find the edge, then put on the hedge. So let's jump in and take a look, shall we? First of all, on the valuation front, just taking a simple look at PE ratios. Here's a generalized one on the triple Qs. It's hard to really pin it down simply because it's an ETF, not an individual stock. But here's a generalization that current PE is just over 37 times, 3-year average just under 35. So certainly fairly rich on a comparative basis, over 7%. Price to sales even more so, about 25% over the 3-year average. Same things, price to book, price to tangible book, and price to operating income, all at extremes to the 3-year average. I also take a look at the holdings, right, because the triple Q is fairly concentrated. Here you can see the top 10 holdings have 50% almost of the weighting. So I simply took a look at the recent PE ratios of the top names in the triple Q, the top 6, which really are the driver of how the Qs move. So here is NVIDIA number 1, right? You can see a 1-month PE ratio, certainly well off the lows going back towards the end of March, right? Trading at by far the highest multiple. Apple now number 2 at absolutely the highest multiple as far as PE ratio. Same thing with Microsoft, right? As you look at that, certainly has gotten to extremes over the past month on valuation basis, on a price to earnings ratio, a PE ratio, the most basic one. Also took a look at the next kind of 3 names going back 3 months, right? You can see here's Google, which is trading again at even higher than the highs back in late January, right? We'll take a look at that in a second on the chart, but it's even trading at a higher valuation multiple for all intents and purposes than back then by a small degree, 31.4 times now, 31.32 times. So basically back up at the highs, which marked a high in the market, as we'll see in a second. Meta, the same sort of idea here, right? Now trading at 29.3 times price to earnings. Back then, a little bit higher, right? At the end of January, 30.49, but did not last that long, right? So certainly approaching the highest valuation multiples for Meta as well, and Amazon absolutely trading at a higher PE multiple, almost 35x currently. Back then, when the market reached the highs January 30th, under 34 times. We also like to take a look at the technical analysis, right? So here's the last time the valuations were this high, right? The end of January, as we just saw on the charts, right, on the PE basis, right? So the last time valuation multiples got this high on the NASDAQ and the components of it, right, did mark a significant top in the triple Qs for a long period of time, led to a pullback. So certainly things getting stretched again on a valuation basis. 10-year yield and interest rates have not come down at all in that time frame. Also note on a technical basis, we're about the most overbought we have been, certainly on a 9-day RSI, now over 80, right? The highest level over the past 12 months. So certainly rich on a 9-day RSI. MACD also at the highest reading over the past 12 months. We're seeing Bollinger percent B basically matching the highest levels, right, over the past 12 months. Interesting to note too, right, that in the month of April, and I'll shorten this up, right, we're trading at a massive premium, the biggest one by far over the 20-day moving average as well. So all the technicals certainly as overbought as they have been over the past 12 months, and shorten this up to when the lows took place, right? to end, March, right? We can see March 31st, the triple Qs, right, closed at 577.18. March 30th, which marked the absolute lows, right? Triple Qs closed at 558.28. Since then, we have not had a down day, right? We've been up 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 trading days. 13 straight trading days, one of the longest stretches in market history. The entire month of April so far has not had a down day on the triple Qs, right? Certainly probabilities, I think, are favoring at least a pullback somewhere along the way on a technical basis on a triple Q that is the most overbought technically we have seen over the past years, being up every day in April since bottoming out at the end of March. And then implied volatility, always like to take a look at that. So I pulled off the IV chart, both the 30 and the 60-day for this one. You can see trading at by far the lowest levels really of the year almost, right? Reaching to the lows we saw to start the year, right, with IV. So that means option prices, nervousness, if you will, the fear factor getting very cheap here. Here's a kind of generalized 20-day IV look, right, on a 25 delta put and call. You can see over the past 20 trading days, right, 20 days ago, right, basically IV trading at just under 30, right? Now we're under 20 and at the lowest level we have seen over that time frame as well. More importantly, the put call differential, right, if you will, that skew between the puts and the calls is now at the lowest level by far we have seen. Call prices have come down from an IV standpoint, right, moving from 21.5 to just under 17 for a little over a 4.5 vol point drop. But the put IV, right, has gotten very cheap from 31 basically to 21. So a 10-point drop in put IV. So puts have lessened dramatically. That downside protection people are no longer paying for. Puts getting very cheap as well. IV getting very cheap, and especially on the put side. Here you can see the current IV percentile, now at only the 26th percentile, so not too expensive at all, right? Basically over the past year, it's only been this cheap 25% of the time. That includes all those previous spikes, right? And you can see IV starting to still just kind of leak a little bit lower here, but leveling off, as we said, right around that level that we see currently. Here I pulled off a 3-month chart for a 30-day 20 delta put, right, negative 20 delta put. You can see it has dropped precipitously from not too long ago with the market at the lows, right, dropping from the 35-ish level, right, now down to the low 20 level. The last time IV was this low over the past 3 months, right, coincided, as we said, with that kind of high in the market as well. So we had valuations at the highest level we've seen since Friday's close, right? We've seen IV at the lowest level, so that combination of overbought technicals, overvalued fundamentals with very cheap puts, right, leads to absolutely a consideration of a put purchase. So I actually took a comparative from the market on the lows, right, as we went back in time, right? So took a look at this period here where the market kind of bottomed out around that 560 level to Friday's close. So on the end of March, the triple Qs closed at 558.28. The 530 put was the one comparative, closed about $4.30, give or take, over a 34 IV. 13 days to go to expiration. Compare that to Friday's close with the 622 put, right, with the triple Qs now at just under 650 at 648.85. IV now at under 24, right? Back then it was basically at 34, so a big drop in IV. 13 days to expiration back here. Now 20 days, so I gave it a week extra time, right, and did the comparison. So here was the Qs back then on the lows to the highs, right? The delta on both puts -20, so I took an absolute similar put, right, from a delta perspective. So I looked at the 530 put back then with the markets on the lows at 558.28, a 622 put now with the market on the highs, right? So back then it was out of the money by a little over 28 points. Now on Friday's close, under 27 points. So $1.43 closer to the money now. So closer to the money, right, should mean a more expensive put, right? An option that's closer to the money should trade at a higher price than ones that's further out of the money. And certainly on a percentage basis, almost a full percent closer to the money now versus the comparison back then on the lows. And remember, days to expiration, we got 7 more days to expiration. Looking at the one today with 20 days, right, versus only 13 days on our comparison, right? Did that purposely just to show you more time, right, should make today's option more expensive, right? Closer to the money should make today's option more expensive, right? But instead, it is actually 30 cents cheaper. Why? Because IV has gotten the tomahawk chop by almost 11 vol points, or over a 30% drop. So that huge drop in IV now combined with an overbought technical market, no doubt about that, the highest overbought readings of the year, and overvalued similarly, right, to back when the valuations were this high, certainly leads to considering a put play, right, given the fact that this market has not been down, right, in all of April, going up every day this month. At some point, I think we're going to have that inevitable pullback, at least towards that 20-day moving average. So with that said, as we always like to say, trading is all about probability, not certainty. Does that mean the market's going to go down just because it's the most overbought it's been in the year, the most overvalued it's been in well over a month, and implied volatility, i.e. the price of options, especially the puts, as we just saw, is the cheapest it's been? No, but buying puts now means that you're getting in at a much cheaper price, right? Putting these all three together puts the odds in the favor, and at the end of the day, that's all you can ask for. So until next time, as always, here's to good trading. Take